So mortgage rates are going up, and some in the home buying market might assume that that's a good way to get home prices to go back down. Maybe mortgage rates will reduce the demand for homes, which it probably will. There will be less people in the market for new homes when mortgage rates go up, but that's not going to reduce the prices on homes that are for sale. And here's why. The demand side is only one side of the marketplace. If rates go up, certainly there might be a reduced demand, less buyers looking to purchase with higher rates. However, the other side of the supply and demand equation is the supply side. For the same reason that mortgage buyers, new home buyers, are going to be staying out of the market, more new home sellers are going to be staying out of the market. This is going to have an impact on prices, pushing them up even higher. So in this particular case, mortgage rates going up dramatically are going to make house prices go up even more dramatically. So let's do some math and see how this works. Let's suppose you have a typical homeowner who purchased a house maybe 5 or 6 years ago for roughly $300,000, maybe $350,000, which, in 2017 or 2018, you can get a pretty decent house for $350,000. And maybe they put down 20%, so they had $70,000 down. They maybe financed $260,000, $250,000, let's say, and they paid their mortgage for a few years. And whether they had a low interest rate from when they purchased it in 2014, 15, 16, or they may have refinanced. Interest rates were below 3% for a good 18 to 24 months in 2018, 19 into 20. So even if a person didn't buy a house during that time period, they could refinance at a lower rate. So now you have a typical home buyer who had a balance of roughly $240,000, $250,000 on their house, and either they had a low interest rate already from when they purchased it, or they refinanced in 2017 or 18 or maybe even 19. So here's what you have on the screen. We're going to use the Google Mortgage Calculator, which is a pretty good tool to calculate payments. So now you have a $240,000 loan amount, principal balance, 30-year mortgage at 3%, gives you a mortgage payment of about $1,000 for that scenario. And certainly not everybody is in that scenario, but that's a pretty typical mortgage balance for an average consumer. So let's say that homeowner now wants to upgrade their house. They want to trade up. Well, certainly that house is worth way more than $240,000. It's worth way more than the $350,000 they paid for it. It's probably worth maybe $500,000, maybe $550,000. In some markets, it could have doubled. It could be $650,000. So they're going to sell their house, and they're going to have a very large equity position that they can cash out. Let's say the house is worth $650,000. So in rough terms, after commission, $650,000 minus $240,000 mortgage, they're going to have $400,000 to put down on their next house. It's pretty significant. But what are they going to buy? If they're in a house already that's $650,000, they probably want to upgrade their house. They're not going to buy another $650,000 house more than likely. They might think, well, let me take that $400,000 down and let's buy an $800,000 house. It's not that much more, right? It's going from $650,000 to $800,000. Maybe their income has increased. Maybe they figure their equity will help them jump up to another house. So let's take a look. If they buy an $800,000 house, they use all of their equity, $400,000, to reduce it to $400,000 mortgage payment. Well, It seems like that's pretty reasonable. It goes up to 1686. However, the interest rate's not 3% anymore. It's higher than that now. Depending upon where you're shopping and when you're watching this, it might be 6%. So let's put in 6%. Now you have a mortgage payment of $2,398, $2,400 from $1,000. It's a 150% increase in their mortgage payment. Certainly, that home buyer expected their mortgage payment is going to go up when they trade up house. But they're trading up from $650 to $800, and their mortgage payment is more than doubling. Plus, their tax and insurance will be much higher as well. A large number of potential home sellers are going to do this math and look at it and say, I don't want to do this. We could take that $1,400 a month every month and put it into updating our home. That's $15,000 plus per year, $16,000 per year in extra mortgage payments. Somebody could save up 2 or 3 years and put a nice addition on their house, upgrade their kitchen. So a large number of the people who would be selling their house to buy a new one aren't going to do it once they see this math. It's not going to work. There's no point. Most of the inventory that goes into homes being for sale, resale inventory, comes from people selling their house when they upgrade. A vast majority of those people now, with rates going up, are not going to do that. If the rate was the same, let's say it was 3%, well, they go up $600. Yeah, going from a $650 house to an $800 house, it's going to be $600 more a month. We get it. It's a better house. It's worth it. We can afford it. We got a raise. We have some extra income. We're more solid. So, yeah, let's do this. Let's go up to $1,600. But once they see that the new mortgage rate at 6% is going to put them $2,400, it's likely that a vast majority of those people are just not going to sell their house. They're going to stay right where they are. They're going to stay put. They're not going to move. That is going to keep housing prices where they are, and probably even higher, because without those houses coming on the market, there still are new, fresh home buyers that want to buy a house. People that are living in apartments. People that are getting married, moving out from their parents. People that are graduating college. People that are previous renters or not homeowners, putting a demand on the home market. They're still going to need a place to live. Without the prior homeowners selling their inventory, the only place to rely on is new inventory, and there's a shortage. According to most estimates, there's a shortage of at least 5 million homes in the market. Home builders can't build them fast enough. And when they are building them, there's a demand from investment companies looking to buy them to rent out. So home values are not going to go down because interest rates went up. In fact, the rise in interest rates is a direct effect on making home prices go up. When it jumps up this fast, this dramatically from very low to high, it has a negative effect on prices. Instead of making prices go down, rates go up, prices go down, it does the opposite, because people now have on mortgage handcuffs. They can't move from their current house, because even if they bought the same price house, their payment's going to go up. And no one's going to buy the same value house. You might as well stay where you are. So for those waiting and hoping that the rise in interest rates are going to eventually lower home prices, it's not going to happen. Now, there's a trap in this. You will see in the news statistics and trends of home sales going down. That's going to happen. But what they're talking about is the rate of sales, how many homes are sold. So when you see Sales of homes went down 20%. Sales volume of houses went down 18%. That's not the price. That's the number of houses being sold. The house price is still going to go up. It's just that there will be less of them for sale and less of them being sold because of inventory being short. And even when there are homes available, they may stay on the market longer than they did before. You know, for the last year, homes were on the market in a matter of days. Sometimes there was multiple offers. Homes may stay on the market longer. You'll see that statistic in the news. Homes on the market twice as long as last year. Homes remaining on the market, 300% longer than they were a year before. That's great. But that doesn't mean the price is lower. It just means they have to stay on the market longer because not as many buyers can afford them. But the seller is not going to reduce the price because they might as well stay where they are rather than moving somewhere else. Now, there are exceptions. Some people might have to move because of their job. There's people who get old and die and they can't keep their house, what have you. But the vast majority of homes are owned by a person who needs a place to live. And transitioning from one place to another is going to cost more money if the interest rate went up. We looked at some interest rate examples here at 6%. It's very likely that by the end of this year, interest rates will be at 7%. Well, at 7% on 400, you're at 2,600. By the time you figure tax, insurance on an $800,000 house, you're going to be darn close to $5,000 a month, $4,600, $4,700, depending on your tax rate and your insurance premiums in most markets. Where if you have this 240 house, remember that number, 4,800, right? You have this 240 house at 3%, you have $1,000 here. You probably have a house that was originally purchased for $325. Your tax and insurance are probably based on that with some gradual increases every year. It's not going to automatically reset and index up to the current 650 value. It might be valued at maybe $450. So you might have $800 in tax and insurance, even if you have another $1,000. So your monthly payment total is $2,000. Well, if you go from $2,000 to almost $5,000 with tax and insurance, because they're both more as well, that's a deal breaker. As a potential home buyer moving from an existing mortgage owned property, you're not going to do it. Most people won't. So this is going to put a big crimp on inventory coming forward, even more pressure on inventory coming forward than the prior year. In 2020, 2021, there were people who sold their house because you can still get a mortgage cheap, 3% range. So if you went from one house to another, you did it the right way, you get your equity, you upgrade your house, yeah, your payment will go up a little bit, but it's not going to be a deal breaker. Well, now that the rates have also gone up in addition to the prices, it has the effect of locking people in to their current house financially, because moving is a non-issue. You're not going to be able to move if the rates are 7%. Inventory is not going to be any better, and demand is going to go even more. There's an echo market of buyers that wanted to purchase in the last 18 months, in 2020 and in 21 into 22, and they now might just be throwing in the towel and saying, I gotta buy, I can't wait anymore, it's not going to go down. So that echo market is going to keep the demand side at the same level. The supply side is going to be lower, prices will continue to go up. So the moral of the story, I know it's repetitive, interest rates going up does not mean home prices go down. In fact, this unique perfect storm of events means that interest rates going up means home prices also go up.